welcome to another episode of the Fast Five, where I give you 5 economic and finance ideas in less than 5 minutes. I'm your host, Brent Stransky. Today is Tuesday, November 18th. Let's get started. The first thing I want to share with you is a snapshot of where we are in the markets today. Things have been pretty calm over the last several months, but there has been some volatility that's returned to the marketplace. In fact, the market was up above its 50-day moving average, a technical indicator, for over 138 days, the longest streak in over 18 years. So I thought it was a good time to check in and share with you a couple of ideas. The first thing I want to touch on is inflation. Inflation's done actually better than expected over the last couple of months. Came in at 3% according to government data in the last 2 months, better than expected. But a gauge I like is Truflation, which I think is more accurate. It measures 7 million real-time technical indicators, and it shows that inflation is at 2.5%. Importantly, one of the primary gauges or measures of inflation is housing inflation and rental growth. It's the lowest in 15 years. Up 1.4%. So we're seeing those cost of housing decrease significantly over the last couple of months. Second thing I want to share with you is that everyone seems so pessimistic in Dow at the moment. In fact, the CNN Fear Greed Index, which measures 7 important indicators and averages them together, is at 12. It's an extremely fearful indicator. It reminds me of a quote from the famous Warren Buffett, who said, you want to be greedy when others are fearful. So at 12, it is an extremely low measurement compared to 50 this time last year. So while people say they're pessimistic, the next chart I have here is talking about credit card spend, and year over year it's up 7.5%, suggesting that the consumer is feeling pretty confident, actually. And so while people say they're pessimistic, this data suggests they're actually a bit more confident. And the next question you might have is, well, are they able to service that debt? And this chart I have here shows you first on the left-hand side that folks' credit rating is actually improving over the last several years, more credit worthy, and their delinquency rates have actually, although kind of increased a little bit after COVID, have started to decrease as well. So that's another good sign. Third thing I want to share with you that's structural to the overall health of the stock market is corporate earnings, and they are supportive of the valuations of where we are right now. In fact, third quarter just reported in the last couple of weeks, 82% of S&P 500 companies beat corporate earnings growth of over 13%. That's double what was expected just at the beginning of the earnings session. Why it's important is because it's the best percentage, the best earnings season of the last 16, in other words, the last 4 years. And this is supporting equity valuations where they are. Corporate earnings are doing very well. Quick, easy one here. I think everyone's talking about gold, silver, platinum. Precious metals have certainly had a run up this year and last year as well. And silver had its first all-time high early this month in 45 years. That's quite a long time to go without an all-time high. And I thought it was interesting to note that we think of silver as a precious metal. It's actually an industrial metal. For every $1 that's spent in investment or savings, $2 are spent on industrial purposes or solar panels. So a little bit about silver for the next time you're wearing a silver or see silver in the news. One of the best performing asset classes so far this year. Finally, I want to end on an optimistic note as we go into the holiday season. I want to share with you that talked about on the first slide that the S&P 500 just dipped below its 50-day moving average, an important technical indicator for the first time in 138 days. That's a very long stretch, the longest in 18 years, and there have been 19 other occurrences in the last 100 years where the market was above the 50-day moving average for 100 days or longer. What happened next? Well, the chart on the screen is showing you those occurrences, and you can see that 1 month later, 82% of the time, stocks were higher. This is better than the average month, by the way, with an average return of 3.5%. So I think it makes sense to stay the course. There are several reasons that the market can continue to do well, including the momentum I just shared with you. Inflation is coming down and better than expected, and corporate earnings have just done so well. So with that, if you have any questions, please let me know, and I'll see you next time on Finance Footnotes.